Research Citi Markets Edition.
I'm Scott Chronert, head of U.S. equity strategy at Citi Research. Welcome to Research Citi Markets Edition, our inaugural podcast covering various topics at work within the U.S. equity markets. In this first episode, we make a structural bull case for the S&P 500, tying in the AI theme. Essentially, we want to set the stage for future podcasts by establishing a longer-term perspective for the S&P 500 that needs to be considered alongside the ongoing barrage of headlines made by many market commentators, which come a shorter term or trading angle and which can also often cloud the longer term picture. Essentially, on Wall Street, we spend a lot of time making short to intermediate or cyclical calls. While the goal is to help investors manage through the vast array of market inputs from a trading perspective, these need to be distinguished from longer term or structural influences. Of course, starting points for investment decisions matter. Over the past 5 years, since the COVID lows, the S&P 500 has essentially doubled. But the past 2 years have been more notable as the market has begun to respond to AI investment with its potentially longer-term ramifications. So, great, Scott. After a 5-year double and a 2-year 50% return, discussing a structural bull case is likely to trigger some skepticism or, less subtly, now you tell me. Still, the underlying storyline is that it's easy to get shaken out of equities as a function of cyclic influences, while it's almost more difficult to wade through the noise and maintain a longer-term, more structurally bullish backdrop, particularly for large-cap U.S. equities. Here's how we see it. First, the connection to longer-term earnings trends is an important starting point. One of the highest correlations we can find between the S&P 500 and longer-term performance is with earnings. Essentially, over time, other than several notable recessionary periods, the S&P 500 performance trend has been up and to the right. Granted, stock price action tends to lead earnings by 2 to 3 quarters. So the headline here is that ultimately, it's longer-term earnings growth that aligns most closely with longer-term performance. Now, as I mentioned, index-level earnings have generally risen over time. The major stumbling blocks have been around recessions or other shocks to the system. These have included the post-tech bubble recession, the great financial crisis, and more recently, the COVID recession. So in navigating equities, it is the risk of significant shocks to the economy or the markets that trigger the most significant sell-offs. Generally, equities in aggregate are pretty good at navigating incremental news flow without risk of major drawdowns. This means that we need to stay alert for shock effects, but even here, the very long-term pattern is that the economy and the equity markets tend to reset, but then move forward. Now, certainly valuations matter, but longer-term metrics like PE ratios have trended in a broad range over time as cyclical influences unfold. Currently, valuations are certainly extended versus history. Still, if you can picture earnings generally moving up and to the right over time, a valuation overlay would show an upward bias, but with a fairly wide fluctuation relative to the earnings pattern. In our work, we focus less on the valuation circumstance and more on future growth expectations that we perceive are embedded in valuations. Currently, our measure of implied growth is fairly extended, but reflects some of the structural promise that investors expect from the AI theme. Second, now here's where it starts to get interesting. The mega-cap growth part of the S&P, think the Mag 7, and the broader tech complex, which now incorporates the AI theme, has increased its impact on the index dramatically over the past 2 to 3 decades, at the expense of the more cyclical part of the market. Specifically, the growth part of the S&P 500 has increased from about 12% of the index in the 90s to nearly 40% now. This is coming at the expense of the more cyclical or economic sensitive part of the market, which has seen its weight fall from over 50% in the 90s to roughly a third now. The classically defensive parts of the market make up just over 25% of the index. The point here is that composition of the index has become more growth-oriented and less economically sensitive over time. We expect this will continue. This has several implications. One is that these big growth companies have hit business model maturation, in a term we like to refer to, where their free cash flow growth is surging, giving them a lot of financial flexibility. This is reflected in CapEx trends, more recently courtesy of the AI infrastructure build-out, and share repurchase as well, where the S&P 500 fully diluted share count has been falling by roughly 1% a year. In our view, this is a significantly different setup than what happened during the tech bubble phase back in the late 1990s. Third, it is also showing up in productivity measures where index-level EBITDA margins have increased from just under 15% to over 19% during the post-financial crisis timeframe. This margin improvement storyline is fairly unique among the global equity markets. This is important as ongoing expectations for increasing productivity over time should ultimately lead to confidence in terminal value and multiple math, in turn moving higher. Fourth, we've argued for several years now that tech providers, which would include semi, software, tech hardware, and many of the media names, ultimately set the stage for tech users. Tech users are mostly everything else that, at some level, are incorporating technological advancements to better manage their more traditional business models. To us, the implication is that ongoing advancements in technology, with AI the latest angle on this, should ultimately lead to better managed businesses with lesser earnings volatility than historic trends suggest. In turn, this should support higher through-cycle valuations. Finally, this all relates back to the U.S. exceptionalism discussion. At the end of the day, our view is that this is more than just a tech growth or AI call. Rather, it speaks to ongoing technological innovation, depth and breadth of capital markets, and governance whereby managements of public equities, and large cap public equities in particular, generally maintain a maniacal focus on shareholder returns. To wrap up, we completely appreciate that many investors will want to drive performance via an ongoing series of trading calls as cyclical influences unfold. And yes, stock selection certainly matters to portfolio performance. Yet, from our perch, the structural setup for U.S. large cap equities per the S&P 500 is compelling. The current AI play, which is attracting very deserved attention, should ultimately broaden beyond those companies most directly exposed to the AI infrastructure build-out to a much broader application to users of the technologies to manage costs, margins, and profitability, all of which should ultimately sustain that longer-term earnings growth picture we described at the outset. Now, on a shorter to more intermediate-term focus, more traditional influences matter. One is traditional macro effects. Here, we're 5 years into the post-pandemic world and still navigating evolving and changing consumption patterns alongside persistent fiscal stimulus. Another is the Fed cycle. At this point, the Fed has passed its hawkish peak and remains data dependent on inflation and employment conditions. We argue the Fed should be policy neutral at this point, which supports market expectations for a series of Fed rate cuts into year-end this year and then early 26. Now, in overall, markets have been navigating President Trump's policy initiatives. Here, the impacts may be structural, but for now we put them in a more cyclical basket as tariffs, budget considerations, and cost cutting, along with government reorganization inputs, all fall into place. And, of course, geopolitics remains an ongoing source of volatility. So through all of this, there's one big takeaway. It is our perspective that Wall Street, that is the S&P 500, is really not that comparable to Main Street, that is the broader U.S. economy. Large cap U.S. equities are increasingly taking on a growth profile. Eventually, there will need to be a handoff from that mega cap Mag 7 cohort to a much broader swath of companies. Our structural bull case for large cap U.S. equities rests on the presumption that the natural tendency for earnings is higher over time as the economy exhibits nominal economic growth. When combined with the ongoing efficiency and productivity enhancements triggered ahead by the AI theme, we expect earnings, profitability, and valuations to support this structural bull view. In future podcasts, we expect to weigh in on many of the structural and cyclic influences mentioned earlier. Establishing a base view will be helpful in putting appropriate context on the seemingly never-ending topics du jour in the equity markets. This podcast was recorded on August 25th, 2025. I hope you found this introductory webcast useful. Thanks for joining me today, and be sure to be on the lookout for our next Markets podcast featuring Dirk Willer, Citi's head of global asset allocation, and be sure to watch for our Research Citi podcasts, which you can view on this same channel. Thanks, and have a great day.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.